IRS audits aren't random anymore, especially going into 2026. The agency is using new data matching tools and AI systems that flag inconsistencies faster than anything we've seen before. And the truth is, the red flags that trigger audits are usually hiding in plain sight. Today, I'll break down the specific mistakes that pull returns into the IRS spotlight, why those triggers will matter even more in 2026, and how to file in a way that keeps you off their enforcement list. The IRS doesn't audit everybody. Here's who they target. The IRS uses mismatched data, algorithms, and income deduction ratios. There's something called a diff score that is applied to every line on your tax return. If that score is out of tolerance, that triggers a manual review and sometimes an audit. Most audits happen because something on the return just doesn't make sense. If the story your numbers tell isn't believable, the IRS will want to take a closer look. Audit trigger number 1. Income that doesn't match your lifestyle. The IRS compares reported income with spending, mortgages, cars, credit card data, and business activity. If you report a very low income but live like somebody making 3 to 4 times more, that raises flags. In one example that I can think of, I was representing a truck driver for an IRS problem. He had liabilities that he owed to the IRS, and he showed $900,000 of gross revenue on his Schedule C driving the truck. By the time the other tax preparer had written off all the deductions, his income showed of just $9,000. And that story just doesn't make sense. Who would drive a truck for $9,000 a year? That just doesn't make sense, and that person was likely to be audited. The second audit trigger is round numbers and estimated expenses. Returns full of perfect numbers like 5,000, 10,000, or 20,000 look like guesses. The IRS assumes estimates are inaccurate, and that creates a higher chance of audit. If every expense ends at a zero, it screams, "I made this up." Audit trigger number 3, aggressive deductions for small business owners on a Schedule C. Home office, mileage, meals. These are all commonly abused and heavily audited business deductions. Business deductions must be ordinary and necessary. Poor documentation equals immediate risk of audit. Small business owners get audited more, not because they're dishonest, but because they're disorganized and unsophisticated. Another audit trigger is large losses, especially year after year. If the IRS sees repeated business losses, they suspect hobby activity. Losses used to offset other income raise suspicion. If the business never turns a profit, the IRS may challenge those deductions. The next audit trigger is mismatched information returns. Information returns are those forms that we all love, like W-2s and 1099s. What happens is the IRS matches what you file with what employers and companies file. If you're missing a 1099, that's one of the top audit triggers. The IRS often already has your income before you file. They're just checking whether you report it. The next audit trigger is issues with cryptocurrency reporting, and these are going to become even increasingly more important. The IRS now tracks crypto transactions closely. Transfers between wallets without clear documentation can cause confusion. Not checking yes to the digital asset question when you should have looks like intentional concealment. Next, high deduction returns in low-income brackets. Low-income filers claiming refundable credits such as EITC, child tax credit, etc. are audited frequently. Not because they do more wrong, but because there's more fraud in these categories. It's really unfair, but it's reality. These audits are painful because most people don't have the records. If any of these red flags apply to you, don't panic and just get informed. I put together a free resource called the IRS Freeze Guide. When you feel frozen about what to do when the IRS comes calling, you need this. You can download it below. What's changing in 2026 and why you can't ignore this anymore? Well, the IRS is implementing stronger data matching and automation. They have more funding, more personnel, and that means more audit reviews. AI detection will catch discrepancies faster than humans ever could. If you got away with mistakes before, 2026 is not the year to test your luck. Let's talk about how to audit-proof your return before you file. You need to report all income. The IRS likely already has it. You need to keep receipts and mileage logs in digital form. Avoid estimates, use your real numbers. Make sure deductions match your industry norms. If unsure, talk to a tax professional before the IRS starts asking questions. Now you know the biggest red flags that actually pull a return into an audit and how the IRS is tightening enforcement in 2026. Even small mistakes that used to slip by won't stay hidden anymore. But here's the part that most people miss. If you've fallen behind on your taxes, even by a few years, those same red flags become far more dangerous. And the IRS's new systems are designed to find non-filers faster than ever before. So before you try to file late tax returns on your own, watch my next video. It walks you through exactly what the IRS does, what options still exist, and the step-by-step path to getting back into compliance safely. See you there.